something broke this month that hadn't broken in over 2 years. For most of 2026, AI stocks only went one direction, up. Then, in the span of about 3 weeks, that stopped. Micron dropped 13% in a single session. That erased roughly $138 billion in market value in one day from one company. AMD fell nearly 7%. Intel fell 9%. Even Nvidia, the stock everyone assumed was untouchable, slipped. The Nasdaq dropped over 300 points in a single session. Global semiconductor companies lost a combined $3.3 trillion in market value this month alone. So what actually happened? And why is everyone suddenly this nervous after 2 straight years of nothing but gains? Part 1. Let's start with what actually triggered this. On July 1st, Meta announced something called Meta Compute. It's a new business unit. Its job is to sell Meta's surplus AI computing capacity to other companies. Read that again. Surplus. For 2 years, the entire AI story ran on one assumption. There was never enough computing power to go around. Every hyperscaler was a buyer, competing for scarce chips. Meta just said, out loud, that it has more than it needs. That single sentence undermined the core assumption the entire trade was built on. If Meta has extra GPUs to sell, maybe the scarcity was never going to be permanent. Then, 2 weeks later, a Chinese AI lab called Moonshot AI released a new model, Kimi K3. Analysts started calling it DeepSeek 2.0. You might remember the first DeepSeek moment. Back when a Chinese lab showed it could build a competitive model for a fraction of the assumed cost. This felt like a rerun of that same fear. If a much cheaper AI model can compete with American frontier models, that raises an obvious question. Why do American companies need to keep spending hundreds of billions of dollars on chips? On top of that, SK Hynix signaled it was slowing down its memory chip expansion plans. Add a hawkish new Federal Reserve chair, Kevin Warsh. He took over in May, and he's been signaling a tougher stance on inflation than his predecessor. Put all 4 of those things in the same 3-week window, you get the sharpest AI stock sell-off since the trade began. Part 2. Why does one bad month for chip stocks rattle the entire market? Here's the thing most people don't realize. This isn't really about semiconductors. It's about how much of the entire US stock market is now riding on a handful of the same companies. The top 10 stocks in the S&P 500 now make up more than 40% of the entire index. At the peak of the dot-com bubble, that concentration topped out around 27%. We are more concentrated today than we were in 2000. And almost every one of those top 10 companies is making the same underlying bet. AI. Nvidia sells the chips. Microsoft, Amazon, Google, and Meta buy the chips. Their earnings all depend on each other, in a loop. Goldman Sachs estimates that AI-related companies have added roughly $27 trillion in market value since late 2022. That's not a sector rally anymore. That's most of the stock market's entire gain, concentrated in one theme. So when investors get nervous about AI specifically, they're not getting nervous about 10 stocks. They're getting nervous about the engine that's been pulling almost the entire index higher for 3 years. Part 3. Why do valuations look historically high right now? There's a number that's been quietly climbing behind all of this. It just crossed a line that's only been crossed once before. It's called the Shiller CAPE ratio. It measures how expensive the entire S&P 500 is relative to 10 years of inflation-adjusted earnings. As of late July, that ratio sits at roughly 40.9. The long-term historical average is around 17. There's only been one other period in over 150 years of market history where this number went above 40. November 1999, right before the dot-com crash. Back then, the ratio peaked at 44.19, and the market didn't turn around gently. Historically, every time the CAPE ratio has topped 40, the same pattern follows. The S&P 500 has fallen by an average of 30% over the following 3 years. Now, add leverage on top of that. U.S. margin debt, money borrowed specifically to buy stocks, has crossed $1.3 trillion. That's an all-time high as a share of the economy. And there's one more number that makes this specifically about AI, not just stocks in general. JP Morgan found that AI capital spending has grown fast. It went from about 33% of hyperscalers' operating cash flow in 2023 to an estimated 93% today. These companies are now plowing nearly their entire operating cash flow back into AI infrastructure. There's very little room left for anything to go wrong. Part 4. So what could actually trigger a real sell-off, rather than just a rough few weeks? A few specific things are worth watching closely. First, hyperscaler earnings. NVIDIA, Alphabet, and Amazon are all set to report soon. Analysts say there's one number that matters more than revenue: free cash flow. If capital spending keeps rising while free cash flow keeps shrinking, that's a problem. That's the exact pattern investors have already started punishing this year. Second, Chinese competition. Kimi K3, or another cheap Chinese model, could prove it can match American frontier models at a fraction of the training cost. That would undercut the entire justification for hundreds of billions in U.S. infrastructure spending. Third, the Federal Reserve. Chair Kevin Warsh has already shown he's willing to prioritize inflation control over supporting asset prices. If the Fed holds rates higher for longer while earnings growth slows, that combination has historically been rough for expensive markets. Fourth, and this is the one that's hardest to predict, another company doing what Meta just did, admitting out loud that it has more AI computing capacity than it currently needs. Jim Chanos, the investor who first called out Enron, has a number worth remembering here. He's pointed out that hyperscalers used to earn about 40 cents of operating profit for every incremental dollar spent on AI infrastructure. Today, that number is closer to 20 cents and trending toward 10. His own estimate is that the reckoning point lands somewhere between late 2026 and 2027. Part 5. Is this actually another dot-com bubble? There's a real case for both sides here, and it's worth being honest about both. The bear case is the one we've just walked through. Record concentration. A CAPE ratio matching 1999. Record margin debt. Capital spending eating almost all of hyperscaler cash flow. And a market that just showed, in real time, how fast sentiment can turn when one assumption breaks. But the bull case is genuinely different from 2000, and it's worth taking seriously. In the dot-com era, most of the companies driving the bubble had barely any revenue, let alone profit. Today's biggest AI companies are nothing like that. Microsoft, NVIDIA, and Alphabet generate enormous real profits. They generate enormous real free cash flow, even after all this spending. NVIDIA alone has a projected backlog of roughly $1 trillion in confirmed chip orders through 2027. That number comes from actual purchase orders, not speculation. Cloud revenue at the major hyperscalers is still growing by double digits. That's driven by real customers paying real money today, not hypothetical future demand. So the honest answer is that both things can be true at once. The valuations are historically stretched by almost every measure we have, and the underlying businesses are also genuinely more profitable than anything that existed in 1999. Whether that difference is enough to prevent a serious correction, nobody actually knows yet. Not even the analysts making these calls for a living. Part 6. What happens next? There are two ways this goes from here. Scenario 1. This month was a healthy reset, not the start of something bigger. Hyperscaler earnings come in strong, and free cash flow concerns ease. The market treats this July sell-off as a footnote a year from now. Some analysts still believe AI infrastructure spending has real growth ahead of it. They think current profits justify at least part of today's valuations. Scenario 2. This was the first crack. More companies admit they have excess capacity. Free cash flow keeps shrinking at the same time the Fed keeps rates elevated. And the CAPE ratio does what it's done the only other time it crossed 40. It drags the broader market down with it over the following few years. Either way, the number worth watching isn't the stock price of any single company. It's whether the next earnings call brings more spending promises or the first real signs of restraint. Because right now, the market has only seen one company admit it might have spent too much. The question is whether it's the last one or the first.